Have you been thinking about diversifying your property portfolio, but unsure how or where to invest next? SJR Property Group is a buyer's agency based in Perth, specialising in helping East Coast investors diversify their portfolios. We focus on helping our clients achieve their financial goals by investing in high-quality, high-cash-flow investment properties that are poised for long-term capital growth. If you've been thinking of investing in the WA market, the team at SJR have feet on the ground and are here to help. Visit sjrpropertygroup.com.au or call us today on 1300 757 774 to chat with an expert.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. I hope you're well joined for our regular catch-up for all things finance, which is as relevant today as what it has been at any time over the last 10, 11 months as we went through this interest rate rise regime. Who knows where that's going to end or finish, but I know every single person I speak to that has a mortgage is really thinking about this right now. And if you're not yet looking at your mortgages, you're absolutely mad. I'd suggest getting into it. That's why I bring Mortgage Broker in every couple of weeks to give us an update on what's going on. Joined today by Eva Lawrence from Finney Mortgages. She's a senior broker over there. Eva, how you going? You well?
Good. How are you?
I'm very good, thanks. And you're getting more phone calls recently. Is everyone panicking about mortgage rates?
Yeah, there's a little bit of panic out there, but there's always options to help. So doing good work.
Yeah, and I saw I was reading The Advisor, which is the big platform for the mortgage broking community in Australia, saying that another lender, I think it was CBA, has come out and they will consider reducing buffers by 1% on loans for certain customers. Is this true? Is it real?
Yes, this is called Easy Refi, where technically if you've had a mortgage at a certain rate, if you can refinance to a lower rate, you should be able to do that regardless if technically you can service or not. So it would help definitely a lot of people.
Yeah, this is sort of innovation you'll start seeing around the edges as we get towards this sort of terminal rate, whenever that is. Who knows? Some people are pricing another couple of basis points increase. Everyone's thinking that the governor of the Reserve Bank, Governor Lowe, is going to put a few more in before he departs his tenure as the Reserve Bank governor. So watch this space. Still a little bit of time for him to go in that role. And pretty much universally everyone I speak to say that the interest rates we're paying now, will be paying over the next couple of months, will be on the high side compared to where we will probably finish 2024. So this is a moment in time. This too will pass. But it's what you do now to best prepare yourself, the better off you'll be. So look for those little sort of policy setting changes around the edges. Only your mortgage broker will know these things. If you go directly to a bank, you'll probably get stuck in a phone queue with someone else and not know what to do. So start speaking to your mortgage broker now, and the team over at Finney Mortgages will surely help you out if you need to. But going directly to a bank branch, and I'm not anti-bank. I'm banked with all the banks. Do a lot of work with them. Would I want to, or do I want to really go into a bank branch? Probably not. I was actually in one earlier today, Eva. It was a pretty good experience, to be fair. I was opening up some new accounts with Westpac. So that was pretty good. But to actually go in there and talk about home loans, I don't want to do that. But what I do find is people that do go directly or secure their mortgages directly through a bank, of which there is more Australians use a mortgage broker now, 70% of loans written is mortgage broker. There's still people that certainly go to a bank and still see great merit in doing that. And that will be because that's the way the family's always done it. They know the branch manager there, all this sort of stuff. But you do find that often the structures that people end up securing debt in isn't necessarily the right structure, or it might just be a bit simplified and probably not sophisticated enough for what they're doing as an individual. Often banks will view you in a different way if you come through direct channels or the first party channels, what they call it, and therefore their recommendations might not necessarily suit you. And one of those, Eva, that I want to talk to you about today, and you've got a great example around it, is the cross-collateralisation of mortgages. I've really struggled with that word today. That's really, that's interesting. Yeah. So this is what happens, is that what they do is they group all your mortgages together and they sort of take the assets on one and make it consistent with the other. does work for some people and it can help be an enabler for securing more debt. But for other people, it can be quite a messy thing to pull apart in times. What do you reckon, Eva?
Yeah, so that's something we see a lot from when investors come to us after buying maybe 2-3 properties, and it worked so far with their bank, or they thought it worked, and then they come to us and realize when it's time to sell a property or refinance or get more equity out, that things have been crossed. And it can be a real mess to undo.
I've seen it time and time again. And people normally do it when they start investing things the right way. And the word I'm looking for is collateralisation, cross-collateralisation. Collateralisation. That's 7 syllables, right? Collateralisation. That's a big word.
Big word.
Too big for me. Collateralisation. Collateralisation, look at that. I got it now. Cross-collateralisation. But the way it works is as complicated as the word, isn't it, Eva?
Yeah.
Right. So let's have a chat because really good example. And I like to sort of frame a lot of these, like a mortgage, right? A mortgage you can't see, feel or touch it, right? A mortgage is just some numbers that you are accountable for paying back over time. So it's always good to sort of talk about mortgages in the realms of a real life case study. And that's what we do when we always get together on the Smart Property Investment Show, Eva. We've got a really good case study here. We'll go into it. We'll just go to a quick break. Stay with us, everyone. Back in a moment.
Are you feeling the strain of high mortgage repayments? Refinancing with Finny Mortgages can help you save big on your home loan and ease the burden on your finances. Our team of expert brokers specialises in helping Australian investors find the best possible rates. Refinance with Finny Mortgages today and start saving. Visit finny.com.au or call us now at 028 866 2444 to chat with an expert.
Welcome back, Phil Tarrant from Smart Property Investment, chatting with Eva, the senior broker over at Finny Mortgages. Contact these guys, finnymortgages.com.au. Now, Joe is a single guy in his mid-30s, and that's as much as I know from the briefing you've given me. So tell me about Joe.
So Joe has been trying to do, the best thing for himself, bought his home, bought an investment property, and is doing well. He's working as an engineer in the mining industry, and thought that he would relocate to Perth for better work opportunity. So as many people would do to buy his first property or his first investment property anyway, he went to his branch, said, I want to use the equity in my home because, that's what we say anywhere, whether we're crossing or not. And he bought his first property using the equity in his home and, just went ahead and didn't think twice about it. Now he wants to relocate, so sell his home and move to Perth. And that's where everything started to crumble.
Okay, so he's got a principal place of residence that has equity in it. He's gone, I want to invest in property. I'll use that equity. But what the bank has done is pretty much pooled the two assets together so they become one and the same. And therefore, the debt is interconnected, which means that if he wants to do something with one of them, it impacts the other one. And that's the cross-collateralisation. So the collateral being the actual asset, which is the house or the home or the investment property. So that doesn't sound cool.
Doesn't sound cool, but that's what most banks would do actually if you go and invest.
Why do they do that? Do you know?
So there's a few reasons. One is obviously it's really good for the bank to have, their hands in every properties you own. So, it makes it a lot harder for you to leave the bank if they have access to everything. Two, it sounds a lot more, a lot simpler for anyone to do it that way. You only have one loan for your home, one loan for investment, one loan for each investment you might get next, instead of having your home, a cash out for the investment, then the investment loan, and do it all over again. So it's a lot simpler, to understand if you're not a sophisticated investor. And I think the third reason is for the banks or for the brokers, because some brokers might do that too, is it's a lot easier as well for us to write that way. It's a lot less work. So if there's a bit of, we call it lazy writing there, that can happen from the bank or a broker that would cross your properties.
So essentially they just take the equity out, they increase the loan on the principal place of residence, and then they shift the money over as the deposit for the investment property. So it's all within the same ecosystem. Yeah. Okay. And it does have its merits. And,
in theory, it's great. It works fine until you need to do something.
Until you need to do something. And I imagine they would say, well, we can give you the same or a very similar interest rate to what you have on your principal place of residence if you do it in this structure, rather than, well, that becomes you're a property investor and therefore you're going to have to pay higher rates around it. So every bank is very, very different. I'm really generalizing there, by the way, but there is a lot of people who would be proponents for cross-collateralizing your home loans, but everything has positives and negatives. One of the negatives of cross-collateralization is that it's a lot more complicated if you want to start doing stuff inside of your portfolio. It can potentially impact the other loans connected or interconnected to these assets should you try and start pulling it apart. And also, you don't want to have all your lending with one bank, because if one bank goes, well, I'm raising interest rates, and other banks choose not to, well, you can't do a lot about that. And this is back to the point with this notion of a mortgage prison. Mortgage prison is, I don't have the serviceability to refinance my home loan. However, I can still continue to pay the mortgage with the bank that I am with, albeit at a much higher rate. So that's why you're trapped, right? They're not going to come and take your home off you, but you're trapped inside of this ecosystem where you're at the whims of the bank and with very little room to negotiate. So that's why you're seeing those things around the edges. If you're cross-collateralized, that's going to be even harder to try and find or secure more competitive rates or more favorable products in this environment. So pros and cons either.
Yeah.
Okay. So what did you do with Joe? So why did he come to Finney?
So he's got a property in Newcastle. His home is in Newcastle, and he decided to sell that property to relocate to Perth. So in his head, he's got a house worth 800,000. He's got a loan for 540, and he thought he would sell it, take roughly 220k, move to Perth, buy his next property, and just go with that. So he goes to his bank and sort of prepare the bank for the discharge. I'm going to sell my property. Just get ready. And then the bank said, hold on. Your property here is used as well as a security for your investment property. And when you did buy your property for $460,000 last year, you actually borrowed $485,000. So you cannot sell your home. Otherwise, you're going to end up with a loan for your investment property that is higher than its value. So they did make him panic a little bit for sure, and said, look, you have two options. Either you don't sell, you sell everything, or you're going to have to pay your investment loan down quite a bit. So he came to us with a bit of, what do I do?
And you go, yeah, we've been here before, don't worry about it.
We've been here before, pretty much.
So I'm sort of going to telegraphing what you would do about it. But so you sat with him and he said, this is what's happened, this is the situation. Did you use it as a chance to educate him on the way this is how? Yes,
he had actually no idea how it happened actually and how it works. So it was definitely a bit of wake-up call and education piece there for him. And so he realized that really he used the equity in his home like, we would do regardless, but that he ended up with a loan for an investment that was so much higher than value that he definitely had to rethink about his plan, because he would end up having to, that's what he's actually going to have to do. He will have to spend pretty much 100K worth of his sales proceeds to reduce his investment loan.
So did he originally take the investment loan at 90% LVR, did he?
No, so he crossed it. So he borrowed $485,000, so 80% against his investment and the rest against his home.
Okay. So he's sitting there thinking, well, I can't move to Perth anymore to find new work opportunities because
in his head he had 200K. Now he's only going to have like roughly 100 because he will have to reduce his investment on quite significantly, which 100K seems like a lot as a deposit, but if you buy a property for 600-700K, it's not that much.
Gets chewed up pretty quickly. All right, well,
you have to pay LMI again. So yeah.
So there's a number of ways that you could probably sort of frame and shape this. So let's chat through the solution, Eva. We'll just go to another break. Stay with us, everyone. See you soon.
Are you on the lookout for your next investment property? Smart Property Investment and Pure Property Investment have done the research for you on where the hottest up-and-coming suburbs for 2024 are and where you should invest for the best return. The report is completely free to download. Visit smartpropertyinvestment.com.au. Don't make any moves until you've read the report. Take your next step with all the facts, backed by research and industry experts.
Welcome back. Having a chat with Eva over at Finney Mortgages about sort of decoupling cross-collateralized loans and assets, which has good points to it and also some negative points to it. And we've sort of covered off the positives. And no doubt for our example here, Joe, it probably helped him get an investment property easier at the time. It's just a bit harder when he wants to get out of one of those assets while keeping the other. So what did you do, Eva?
So the issue we have also with Joe is he's in between jobs. So he's got no income to show to the bank. So technically we can't refinance him. There's not much actually we could do in terms of getting more lending for him or changing securities behind the scenes. So what he has to do is decide if he wants to pay LMI on his investment property to reduce the loan to 90% or put quite a bit there and reduce the loan to 80%. But the more he will put into reducing that loan, the less he will have for his owner-occupier purchase in Perth. So it's kind of a bit of a tricky situation for him. He hasn't decided yet what to do. But what we're trying to avoid here is him paying LMI on his investment property and again on his home purchase in Perth in the near future.
So this is not financial advice anyway. We're just sort of talking about a generic example here. So there's a number of ways you can frame this. So what you're saying, I don't know how you could do this, but from what you're saying, so can you go and retrofit LMI to a property which is cross-collateralized and potentially negative equity?
Yeah. So at this stage, his loan is 485 for a value of 460. The bank is not going to let that happen. I would say it's, you have to sell. If you sell your home, you have to sell your investment as well. Or you will have to reduce that loan to a level we are comfortable with, which is either 80% or 90%. If it's 90, LMI will be applicable.
So can't the bank do that with him right now? Why does he need to go to a mortgage broker to do all this?
No, the bank could do that with him. He came to us to check his options, I guess, and make sure he didn't sell or doing the wrong thing, or if there's anything he could do to avoid having to spend so much money on the investment.
See, and there's sort of this immediate moment for him, but there's probably a more midterm solution. I'm just thinking out loud, and again, it's not financial advice in any ways, and everyone's different. But you could go. What I would say, if it was a mate of mine, to go, mate, go to Perth, rent out your principal place of residence for a period of time while you're over in Perth, go and get 6 months of pay slips from a new employer and then refinance the whole lot is another play, right?
Yeah, we actually discussed that option, and that's what he might end up doing. Yeah, and it would depend, I guess, on how much he earns and how much he can borrow, because he might not be able to buy a new home if he keeps the one in Newcastle. So.
Yeah, but you know what? That might be even a better investment, right? It's a podcast for property investment. Do you and you would need to speak to your accountant around that. I would recommend it because there's rules around if you move out of a principal place of residence and you rent that property out. There is, I can't remember, it's a certain number of years, 6 years, 7 years, 8 years, I can't remember what it is, before you can move back there, and it's still, the capital gains context of it is changed. So it can be a sort of favourable or beneficial thing. You don't lose the benefits of being a principal place of residence, but that is absolutely an accounting thing. But then, that's the basis that if he rents out his principal place of residence and turns it into an investment property in Newcastle, which will be getting rent on, it might be a big disconnect between what the debt is on it or what the mortgage repayments are on it in this environment versus what the rent's generating. Therefore, it's negatively geared. And if he needs to rent over in Perth while he sets himself up, he might not have the cash flow to do that either, right? So he's really stuck.
Yeah, and it's a tricky situation. And I thought that was quite interesting to bring to this podcast because a lot of people would actually or could be in that situation without really knowing it until something happens in their life. They have to relocate, sell something. So it's, I think, bringing a bit of awareness around it.
Yeah. And you might think, well, yeah, my properties are cross-collateralized, but it doesn't matter because I'm not going to do anything with it. But, it would be worthwhile, even if you're not looking to buy or anything, it would be worthwhile going to a mortgage broker and saying, I've got these properties that are cross-collateralized. And loan structures get weird on as well. Some are fixed, some are variable, some are P&I, some are interest only and all this sort of stuff. Speak to your mortgage broker before it becomes a problem and go, hey, should I detether these properties into separate single assets, which aren't interconnected in the eyes of the bank, and maybe put them with different lenders, or look and use that period of time to refinance them from a P&I to interest only, or you might be resetting or whatever you're choosing to do. You're best off having optionality. So if and when things change, you'll have the capability structurally to actually ebb and flow and move and take control. And that's what I'd be recommending. That's not financial advice. I think that's just smart practice. The banks will be saying, no, cross-collateralization is a great idea because it does all these things. And go and Google that and it'll tell you all the positives of it. But if you're a proactive property investor and you're actually accumulating properties as part of your retirement plan and your strategy, speak to your accountant, speak to your mortgage broker and actually go through this, because you want to be able to act and operate in isolation and within each individual property, whether that's the bank that you're with or the type of loan you have on it. You might have some properties which are really high yielding and positively geared and some which are negatively geared. And you sometimes don't want those things living together within the same ecosystem or relying on each other, because that can be problematic, Eva.
100%. And then the issue is, when you do want to do something, sell one property, get a better interest rate on one, bit of cash out, everything basically is part of that ecosystem, and the bank will have to take into consideration everything to give you a yes or no answer. So if you've got a property that's performing poorly within that portfolio, it will affect everything. So I guess the key thing here is you can uncross your property. And if you're still in the situation where you really should look at doing that while refinancing and maybe grab a better rate as well.
Yeah. Do you need to go to a broker in order to cross-collateralize your properties, or can you go just directly, if you're with the bank, you go, I don't want these to be crossed anymore? Are they pretty accommodating?
You could do it probably with the bank. Some of them, they would, behind the scene, they would cross anyway. What you can do is, when you actually sign your loan documents, there is a section there that talks about the security on each loan, and they are listed there. So you can always check, what properties are used as security for each loan. But the bank, 99% of the time, they would cross it anyway. That's what they do. Even if you know it or not, that's what they've done.
Share a wallet is what they say inside a bank. A lot of banks don't like the mortgage broker channel still. They would rather mortgage brokers went away. And this being one of the reasons why they want to control. They want to control the whole ecosystem there often. And look, it is not a bank beat up by any means. Banks, I'm a shareholder in banks. I want banks to be profitable, but banks want to try and control the outcome favorably as possible for them. And that means trying to retain all the business directly with them. So often they don't necessarily like mortgage brokers. However, it's pretty clear that most Australians that have debt, home loan debt now, want to use a mortgage broker. And this is one of the reasons why, for this notion of choice and a different set of eyes and stuff, someone acting and operating absolutely in your best interest, the mortgage broker, rather than a bank potentially sort of, recommending the solution that might be okay for you, but would also suit them. And that's not being cynical. That's just the way of the world. So speak to your mortgage broker, Eva. If you're going to get a flurry of phone calls of people trying to uncross-collateralize their loans, can you work out whether or not people's loans are actually cross-collateralized if they don't know, if they just want to come and sort of have a bit of a consultation?
Yeah, we can tell very quickly from the structure. Like, for example, Joey says, I've got a $485,000 loan against a property that purchased for $460,000. Clearly, that's crossed. It's not going to happen otherwise. So, as soon as we get to know the property values and the loan, we can work out what's happened and how it's been done. And but I guess the good thing about that is it's never forever. There's ways to cross if needs be and if possible, but it's all based obviously on the valuation of the property.
Okay. So if people want to have that chat, what do? Can they call or email, or how do they get a hold of you guys?
They can get in touch with us through our website, fini.com.au. They can just pop in the details in there, and then we'll book a time to chat and see what can be done.
How do you spell Fini?
FINNI.
Okay. So it says FINNI.com.au.
Yeah.
All right. Cool. Well, thanks for that. It was a really good case study. Good example. Just reminds me of, people talk about, structure, how you invest and what entities you invest in, and the machinations of that. Loan structuring is hugely important because it's only when you want to do something, if you're restricted, it becomes a problem. And sometimes that can be an expensive thing to unwind. So let us know what happens with Joe, what he does, by the way. I'd be interested to know. So that's Eva Lowenz from Fini Mortgages. Go and check these guys out, fini.com.au. Hope you enjoyed this. I'm Phil Tarrant, Managing Editor of Real Estate and Financial Services over at Mentor Media. Hope you enjoyed this. Enjoy doing this podcast. If there's anything you want me to talk about or any guests to get on, or otherwise, you just shout out, email the team, editor@smartpropertyinvestment.com.au. And we'll make sure we sort that out for you. One favour for me, please keep those reviews coming on iTunes or wherever else you choose to listen into this. I'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.